Walk into any shopping mall in Sao Paulo, Jakarta, or Mexico City today. Look at the shelves. It looks like paradise. Cheap electronics, affordable clothes, $10,000 electric vehicles. It feels like the global South is finally winning. But now, drive 20 minutes outside that city. Go to the industrial district. Look at the local textile factory that has stood there for 30 years. Closed. Look at the steel mill that employed 3 generations of workers. Bankrupt. Look at the for sale signs on the small businesses that used to supply them. This is the hidden price tag of those cheap goods. For the last decade, we were told that China's rise would lift all boats. We were told that Beijing was the big brother who would help the developing world stand up to the West. But today, that narrative is collapsing. From the ports of Mexico to the markets of Turkey, the mood has shifted from partnership to panic. The developing world is realizing they haven't invited a partner into their home. They have invited a predator, and now the global revolt has begun. Look past the diplomatic handshakes and look at the hard data. Last week, Mexico announced tariffs of up to 50% on a whole range of Chinese goods. Indonesia, a key partner in Southeast Asia, is putting up emergency trade barriers to stop the flood of Chinese textiles. From Turkey to Brazil, the developing world is no longer rolling out the red carpet. They are rolling out the barbed wire. Why? Because the China shock isn't just a problem for rich Americans or Europeans anymore. The developing world is realizing that China is no longer a partner to grow with. It has become a predator to survive against. To understand why this betrayal is happening now, we have to talk about physics, specifically the hydraulics of global trade. We know the United States and Europe are closing their doors. We've seen the chip bans, the EV tariffs, and the small yard, high fence policies. But here's the thing about a $17 trillion economy. When you close the front door, the goods don't just disappear. They have to go somewhere. China is sitting on a massive problem called structural overcapacity. Their real estate market is dead. Their domestic consumption is crushed by low wages and a lack of confidence. But the factories are still running at full speed. The party needs them to run to keep unemployment down. So, they have millions of cars, tons of steel, and mountains of solar panels that nobody in China can buy. If they can't sell to the US because of tariffs, and they can't sell to Europe because of investigations, where does that flood of cheap stuff go? It flows downhill. It flows to the markets that are still open. It flows into Mexico, Vietnam, India, and Brazil. This is the trade diversion effect. Beijing is effectively exporting its internal crisis to the rest of the world. When they send a $10,000 EV to Brazil, they aren't just selling a car. They are exporting deflation. They are exporting their excess capacity. And most dangerously, they are exporting their unemployment to your country. This is why the developing world is panicking. They are realizing that when the U.S. builds a dam to stop the Chinese flood, the villages downriver, that's you, the global South, are the ones who get drowned. But wait, the skeptics might ask, Robert, isn't this just capitalism? Isn't China just more efficient? Let's kill that myth right now. What is happening in China isn't efficiency. It is financial doping. In a normal economy, if a factory makes shoes that nobody buys, it goes bankrupt. That is the discipline of the market. But in China, that factory doesn't die. It becomes a zombie company. Local governments pump billions of yuan in cheap loans, free land, and subsidized energy into these failing businesses. Why? Because the local officials are judged on GDP growth, not profit. They would rather keep a zombie factory alive than face the social unrest of layoffs. So, you end up with a bizarre reality where Chinese companies can sell steel below the cost of the iron ore used to make it. They aren't selling for profit. They are selling for cash flow. They are desperate to get any foreign currency to pay off their massive debts. This is not competition. This is a fire sale. And for a private company in Brazil or India, which actually has to pay its bills and make a profit, competing against a Chinese state-owned enterprise is like boxing against a guy on steroids who also owns the referee. You cannot win. And this flood of goods has gotten so aggressive, it has birthed a new shady industry. I call it the laundromat. Let's trace the journey of a single ton of steel to see how this game is played. It starts in a state-owned mill in Hebei, China. It is produced at a loss, subsidized by the CCP. If this steel goes straight to the US, it gets hit with tariffs of over 100%. The game is over. So, the steel goes underground. It is loaded onto a ship bound for Vietnam or Mexico. Once it arrives, it enters a bonded zone. It doesn't officially enter the country yet. Inside this zone, the magic happens. The Made in China labels are ripped off. The steel is slightly processed. Maybe they cut it into smaller sheets or just repaint it. Minimal work, just enough to claim a substantial transformation under trade law. Suddenly, this Chinese steel gets a new passport. It is now Mexican steel or Vietnamese steel. It is then trucked north, crossing into the United States duty-free. This is transshipment. It is global trade money laundering, and for years, countries like Mexico looked the other way. Why? Because the port fees were good. The trucking jobs were real. But then, they looked at the invisible ledger. Mexico realized that while their ports were busy, their own steel mills were dying. They were becoming a logistics hub for Chinese profits, not a manufacturing hub for Mexican prosperity. Chinese companies were using Mexico as a Trojan horse to attack the US market, and Mexico was the one getting blamed. This is why the Mexican government just snapped. They realized that being an accomplice to Beijing's trade fraud was destroying their own relationship with their biggest customer, the United States. So last week, they hit the panic button. 50% tariffs. They are trying to shut down the laundromat before the Americans shut down the entire border. So, why can't countries like Brazil, Indonesia, or India just accept the cheap goods and be happy? Because every nation has the same dream. They don't want to just consume wealth. They want to create it. They want to move from farming to manufacturing. They want to build their own cars, their own phones, their own middle class. Economists call this industrialization. I call it climbing the ladder. China knows this ladder well. They spent 40 years climbing it, starting with cheap t-shirts and ending with advanced EVs. But now that China is at the top, they aren't dropping a rope down for the rest of the global south. They are pouring oil on the rungs below. Think about it. If you are an entrepreneur in Jakarta trying to start a textile factory, how do you compete? You have to pay for land, machines, and labor. You have to make a profit. Meanwhile, a Chinese competitor is selling the same shirt for less than the cost of the cotton. Why? Because the Chinese state is subsidizing the electricity, the shipping, and the loans. This creates an industrial kill zone. Any industry that tries to rise in the global south is instantly decapitated by Chinese dumping. Brazil's steel industry? Crushed. Chile's shoe industry? Decimated. China isn't helping these countries develop. It is forcing them into premature deindustrialization. It is turning them back into farmers and miners, permanently. Let's look at the most painful example, the auto industry. For decades, countries like Thailand, Brazil, and Indonesia built their entire industrial strategy around cars. They invited Toyota, Ford, and Volkswagen to build factories. They trained their workers. They built supply chains. They wanted to be the Detroit of the South. Then came the Chinese EV wave. At first, it looked like a gift, cheap, high-tech electric cars for everyone. But look closer at the invisible ledger. These Chinese EVs aren't built in Brazil using Brazilian parts. They are built in Shenzhen, heavily subsidized by Beijing and shipped over on massive car carrier vessels. When BYD or Sherry builds a factory in these countries, it is often just a screwdriver plant. They ship the entire car in a kit knocked down, and local workers just screw the final parts together. The high-value work, the battery tech, the software, the engineering, stays in China. The local country gets the pollution and the minimum wage assembly jobs. China gets the IP and the profits. This is the Trojan horse of green technology. It comes in looking like an environmental savior. But when the doors open, it destroys the local combustion engine industry that took 50 years to build. German car makers are terrified, but Brazilian and Thai car makers, they are facing extinction. And this brings us to the uncomfortable truth that nobody at the United Nations wants to say out loud. If you look at the trade structure between China and the developing world today, it looks hauntingly familiar. Let's look at the receipt. What does Brazil sell to China? Soybeans, iron ore, and oil. Raw materials, dirt. What does China sell to Brazil? Cars, electronics, and machinery, finished high-tech goods. You dig the hole, they sell you the shovel. Historians have a name for this. It's called Colonial economics. In the 19th century, the British Empire bought cotton from India, spun it in Manchester, and sold the shirts back to India at a profit. Today, the flag has changed, but the math remains the same. China wants the Global South to remain a resource colony, a gas station and a grocery store for the Chinese industrial machine. They want your lithium, your copper, and your food, but they explicitly do not want your competition. This is why the mood has shifted. The leaders of the Global South are waking up to realize they haven't escaped Western imperialism. They've just traded a boss in Washington for a boss in Beijing. So, what does this divorce mean for you watching this video? It means the golden age of cheap stuff is over. For 30 years, China acted as the world's deflation machine. They kept the price of your phone, your TV, and your clothes artificially low. We got used to it. We thought it was normal to buy a toaster for $10. But that price was a lie. It was subsidized by Chinese debt and American deindustrialization. Now, the bill is due. As the Global South joins the West in walling off China, supply chains are going to fracture. Factories will move to places like India, Mexico, or back to the US. That sounds good for jobs, but it is bad for your wallet. Production will be less efficient. Labor will be more expensive. We are moving from a world prioritized for efficiency to a world prioritized for security. And security is expensive. Expect inflation to be stickier. Expect interest rates to stay higher. Expect a world where you don't buy a new phone every year because you can't afford to. The China Shock 1.0 was about cheap goods flooding in. The China Shock 2.0 is about the walls going up. And getting stuck behind a wall is never free. So, where does this leave us? We are entering a world of isolation. China is finding itself alone in a room full of broken mirrors. The US has locked the front door, Europe is locking the side door, and now the brothers in the Global South are barring the windows. Beijing's strategy of exporting its way out of trouble has hit a concrete wall. You cannot sell to people you are actively bankrupting. The trade war is no longer just a headline on Bloomberg. It is coming to every port and every border crossing. For you, the viewer, the lesson is simple. The era of global friendship is over. Nations do not have friends. They have balance sheets. And right now, the world is looking at the bill from China. And they are refusing to pay. I'm Robert. And in this economy, trust is the most expensive currency of all.